everyone. Welcome, everyone. We're just waiting a couple minutes to get everyone in from the waiting room, and we'll start the program. Thanks for attending. Okay. Let's go and see if we can start the program now. First up. So I'd like to welcome everyone to a session of NCCPAP Now. My name is Michael Himes. I'm the PR committee chairman, and we wanted to have everyone before the tax season got crazy come and join us for this session. We wanted to reintroduce the NCCPAP Now because it was very popular and go forward with some valuable tax season tips and CPE. So I just want to go over a couple of the rules and groundwork for this seminar. For CPE information, you would contact Alex at the national office. Alex's email and phone number are up on the screen. So if you have any issues related to CPE, please reach out to her. We'd also like to make sure that your first and last name for the chat is in the Zoom. Please make sure that you're not anonymous and that you only use your first and last name so that we can identify you. During the seminar, there will be 6 polling questions at random times. So the idea would be to make sure that for CPE credit that you answer the 6 questions. If you have questions going forward relating to the speakers, because we're going to have 3 speakers, those should be listed in the Q&A or the which is listed in there, and rather than the chat. So please make sure that you list your questions related to the seminar in the Q&A so that the speaker can know that they're being asked a question, and during their seminar and their allotted time, they will make sure that they try and get to as many questions as possible. If you need, the session is being recorded, so the recording can be sent after the completion. I think that we have everyone now who's attending, so we can go forward. Welcome again to all the attendees, and let me introduce the Gary Brown so that we can start off with I'm going to go with Neil Fishman, who is the current president of NCCPAP, for the latest news.
Okay, so well, first of all, as you can see, everybody, polling question 1 is up. So first I want to say good afternoon, and to those not in the East Coast, good morning and welcome. It is very happy to be here. I will first want to wish everybody a healthy and a happy new year. So let's get started. So the first thing I'd like to talk about today is the Uniform Accountancy Act. As we know, there are some changes that are happening to this again. As we know, just to give some background, if you go back about 20 years and earlier, to get the CPA credential, you needed to have 120 college hours. You had to have 2 years of experience, and that included audit experience as well. Then, about 18 years ago, they made a change. They changed it to 150 hours of college credits, 1 year experience, and they did away with the audit requirements. Now, that has presented problems, as we've seen in recent years. For those who are not aware, the number of people who are taking the CPA exam is in decline. And the number of people who are getting the credential and going into this aspect of the profession is also in decline. So the AICPA has been trying to find a way to help people who want to go into the profession to get their 150 hours. A couple of years ago, they were speaking with Tulane University about offering some sort of a work-study program where people would work for a firm, but they would spend part of their weeks taking classes towards getting the 150 hours. Unfortunately, one problem with that is that these classes through Tulane at the time, they were not all necessarily graduate level classes. So that presented the problem that somebody could be possibly duplicating a course at Tulane University that would coincide with that would coincide with the classes they took where they got their undergraduate degree, they got their bachelor's degree. They're still working on ways to get around that, but in the meantime, the UAA is being modified again, apparently. They are now proposing going back to the 120 years at 120 hours and 2 years experience, but they are not bringing back the requirement for the audit experience. It is now just the 2 years experience. The states have been slowly dealing with this. For example, it was just recently announced that Ohio is now changing for a license there to 120 hours and the 2 years experience. Now, we are still waiting to see how all the other states are going to deal with this. Unfortunately, we don't know yet, and this can bring a problem with portability. Because if you get, for example, you get your CPA license in Ohio at this time, I'm using that as the example, but you go to another state, and let's say Florida, where they still have the 150-hour rule, this could present a problem in getting the portability to promote yourself as a CPA. Florida does have a second hurdle in that in order to promote yourself in the state of Florida as a CPA, you must, and I emphasize the word must, have a Florida CPA license. But this will vary from state to state, and we are still waiting to see how this is going to play out. Next, I would like to talk about this coming Friday. This coming Friday at 12 o'clock noon Eastern Time, the Tax Committee is going to be having a town hall. At our national meeting 2 weeks ago, we started working on our congressional agenda for May. I'm sure that everybody is aware that in May, we have our spring quarterly meeting in Washington, D.C. And the big thing about being there is we take one day, we go to Capitol Hill. We set up appointments with congressional offices, on both sides of the aisle, and we are bringing them the issues that we believe are relevant to our profession. And where do we get these issues? We get these issues from the work that we do. We see the inequities in the tax law, and we're just trying to make them equal and relevant to everybody. So we have some agenda items that we are bringing back from last year, but we are always looking for new ones. So if you see something during the season right now, if you think it is an issue that we can address to Congress or to the IRS, please bring it to Steve Mankowski, bring it to Sandy Zimmern, bring it to me. We will work with you. We will ask you to do the initial draft as to how it is to be presented, because we want to make sure that we are getting the concept, the issue, the resolution that you think should be presented to Congress and to the IRS. We're not expecting everybody to write it perfectly, but we want to have your idea. It is your idea to do this. It is your idea that we want to have presented to Congress. So that is the town hall. Now, again, we were talking about Washington. Washington is our big event nationally. We invite everybody to come. How many people can say that they have had the opportunity to go to Washington to meet with congressional offices and to have possibly an influence on legislation? That is one of the great opportunities that NCCPAP provides, because anybody can come. You can go to the meetings. You can talk with, maybe the senator is there, maybe the representative is there, but more likely you are meeting with, hopefully, the chief of staff or the legislative director at these congressional offices. We want people to come. We want you to experience this. It is a great opportunity, and everybody and anybody can come to this. Okay. Next is, well, on Thursday this week, Thursday this week, Steve Mankowski and I will be attending the monthly meeting of the National Public Liaison's Office. Was there somebody say something? No, okay. Of the National Public Liaison's Office. This is where NCCPAP, we are a stakeholder with other organizations such as the AICPA, the National Association of Tax Professionals, the National Society of Accountants, the National Association of Enrolled Agents. We are all there at these meetings every month. We are hearing what is going on at the IRS. And there's a lot going on at the IRS right now. In fact, I saw this morning, don't know if this is good or bad, but there's going to be a hiring freeze at the IRS. How that's going to play out, we don't know yet. But this is where we get to hear what's going on at the IRS, and we get to hear and we get to provide input if they're having any questions about this. We get to ask them questions about what's going on. Again, we are at these meetings every month, and it's our way of letting the IRS know how we as an organization feel about what's going on there, depending on the issues. Steve and I be getting the agenda tomorrow for the issues. It usually comes out the day before the meeting. Correct, Steve? Yes, Steve's shaking his head, yes. So again, we are looking forward to that. Now, one of the issues that is on our agenda is what's been known as the Taxpayer Protection and Preparer Proficiency Act, or as some people in the organization call the Neil Fishman Act. Little background, as many people recall, about 10, 12 years ago, the IRS attempted to unilaterally regulate tax return preparers. This culminated in the case of Loving v. IRS, and the courts ruled that the IRS had overstepped their authority in regulating tax return preparers. After that was the summary judgment, the IRS did their appeal, which they lost. And after that, the then Commissioner, John Koskinen, announced that they were going to wait until Congress granted the authority. So in the last several Congresses, there has been this bill, the Taxpayer Protection and Preparer Proficiency Act, which would give the Treasury Department, therefore the IRS, the authority to regulate tax return preparers. Now, every month, the IRS comes out with a list or statistics from the return preparer office. They list how many PTINs there are. And as of January 2nd, the IRS had issued over 2,100,000 PTINs since the PTIN was created. However, active are only just over 667,000 active PTINs. Now, they do provide some additional breakdown of professional credentials. Of CPAs, of that 667,000, 171,600 are people who have the CPA credential. The other credentials they list are attorneys, enrolled agents, enrolled actuaries, and enrolled retirement plan agents. However, the numbers they give here are misleading because, as we know, there are a number of us who have more than one credential. So if you have the attorney or the enrolled agent credential in addition to your CPA, you're being counted in both categories. Right now, CPAs are approximately 25.7% of the PTINs are to people with the CPA credential. It is very safe to say that when you take the others into consideration, it is only maybe 2/3 to 70% of the people with the PTIN who have no credentials whatsoever. Now, we as CPAs, attorneys, enrolled agents, there is oversight for us. Now, if somebody has a problem with us, they can file a complaint. If you're a CPA, in Florida, it is the Board of Accountancy. In New York, it is the Department of Education. If you are an attorney, it is the state bar. If you are an enrolled agent, it is the Internal Revenue Service. However, all those people who have no credentials whatsoever, they have no credentials, there is no oversight for these people. And also, on top of that, and I'm going to bet that this has happened to me, and I will safely bet that this has happened to everybody listening to this presentation, that every now and then, somebody new comes to us, we review their return, and when we look at the return, we ask the question, did you prepare your return yourself last year? Their response is, no, why are you asking? And then we have to point out that in the signature block, it either says self-prepared or there's nothing there. At that point, we have to point out to the taxpayer, to the new client, that if this return were to get flagged for an audit, that the IRS is going to assume that they prepared the return themselves, that the tax return was prepared by them, and that therefore they knew what they were doing, and they are going to be held to the same standard as if they had used a paid preparer. Now, there is plenty of work for everybody who does this. And this is the thing that bothers me the most, because there is so much work, but the people who don't prepare the returns, who prepare the returns without signing them, they commit errors, they commit egregious errors, and they can walk away from the situation and nothing happens to them. Yes, the person will not come back, but we all have that. Every year we get somebody new, and that person then decides next year to go somewhere else for whatever reason. They didn't like how we dealt with them. They didn't like how we spoke with them. They didn't like the fee after all. They went searching and found somebody who will do the job for less. Whatever reason, we have people who are here this year, gone next year. But the people who come back because they appreciate the service that we do, that we take care of them. When they have a problem, they call us. I always tell clients, if something happens during the year, don't wait till next year to tell me that this happened. Call me now. Let's talk about it now. Let's see if anything has to be done now. So that I'm flying to Washington tomorrow. I will actually be meeting with uh, Republican staff for the House Ways and Means Committee. I will be meeting with the Democratic Congressional Office who proposes this bill to see if we can find a way to get this introduced, to get this, whether standalone or attached to other legislation, to see if we can get this legislation passed. Okay. The last thing I would like to talk about in my time is first, I attended the Accounting and Tax Symposium back in November, and I would like to acknowledge James Hall, Robert Goldfarb, Andrea Parness, and Robert Brown, and the rest of the people at the Nassau-Suffolk chapter who took the time to put the program together. You know, it was about 22 years ago. The symposium was just an idea. Bob Goldfarb, Ross Cass, and a number of people back then took that idea and made it to what it is today, which is, in my opinion, one of the best CPE programs that you can find in the country. They get presenters, they get speakers who, they don't just read the handouts. They expand on the material they provide, they take their experience and they are willing to share that. And for those of you who have attended the tax symposium, you see at the end of the programs, there are people going up to the speakers and asking them questions that they did not get to ask. And this is the greatest thing that NCCPAP has to provide, the knowledge that its members have and the willingness of their members to share that knowledge. We can all get our continuing education credits in various ways. We can do self-study, we can attend video conferences, we can go to live programs. But it is, in my opinion, the live program that is the best because you get to interact a lot easier with the presenter. You get to meet the other people there. You get to meet your colleagues, to talk with them, to find out who really knows more about these topics. We all do the same work more or less, but over the years, our practices have gravitated and we have become experts in certain areas so that if we come across something we don't normally deal with, there's somebody we can always reach out to. You know, in my career, I have had the opportunity to reach out to people. And as I have grown in this profession, I have paid those people back by helping the people who have reached out to me. Okay, it is the collective knowledge of our members. It is something we cannot do without. We are all in this together and we all help each other. And with that, I will say thank you very much for your time. Michael?
Neil, thank you so much for expressing, obviously, the wisdom and vision that you have for your upcoming year as a president, and looking forward to assisting you in any way, as I'm sure a lot of the people who are logged in now also want to do. In keeping the seminar going, we want to hear from our National Tax Committee Chairman, Steve Mankowski, who is going to give us an update of what he sees coming down the pike in Washington, D.C. with the new administration. I also want to remind people that poll question number 2 has just been set up so that you can answer the next poll question as you go forward. I'm also checking the question and answer, the Q&A, just in case anyone has anything that they want to ask one of the speakers. Right, Steve?
All righty. Thank you, Michael. And I'll try to, as I've seen some of what the discussion's been in the chat, I'm just going to try to go through the best I can without belaboring some of the points in my agenda to make sure that we have sufficient time left for Gary for his presentation, which is the purpose of why a lot of people are in attendance today. So without further ado, just wanted to follow up on 2 things that Neil, or a few things from Neil's presentation. One is that, yes, I've also seen that part of the executive orders that got signed yesterday by current President Trump there was a hiring freeze at the IRS that was put into play. And also with the IRS right now, they are a band without a leader, as IRS Commissioner Danny Werfel had submitted his resignation to be effective yesterday. Some of that is in light of the president having a nominee for the commissioner's position. But as we know, it takes a while for that to really take effect, because any candidate goes through several different levels of audits, which may or may not have already been commenced prior to his nomination. And the third is one that's really be interesting to see how it's going to be playing out, which was what was talked about yesterday, being the creation of the External Revenue Service, which is going to be a branch that's, I guess it's a new branch of government that's going to be dealing with some of the various taxes and tariffs that are going to be on items from different foreign entities and such. Stay tuned. That's going to be a big item coming into play. One other item that will be coming up possibly in the next or in the first 100 days of the new administration, but certainly some point, if not in the first 100, certainly before the end of this year, will be some form of tax legislation surrounding the Tax Cuts and Jobs Act provisions, many of which are slated to be expiring or sunsetting as of 12/31/25. I do know that that's been a point of discussion, and it's been one that no matter who you may speak with or hear from in Congress, it is certainly one that they've already been hearing from a lot of groups, including NCCPAP, that if they're going to do something, do it as early in the year as possible so that we can advise our clients accordingly. But rest assured, myself, Neil, and Sandy Zinman will be keeping on top of all of this. And as soon as anything is worth presenting to the membership, we will be sure to get that out to everyone. So without further ado, 2 dates to keep in mind for this current filing season. And obviously these dates do not pertain to those in California, some parts of Florida, and I think North Carolina and a few other regions that have had extensions put on to the 2023 tax year, as well as with, I believe, with California with 2024 being extended already. But for those not in the affected regions, the 2 dates, business returns are now effectively able to be electronically filed as of the 15th of January. And the date that many of us are really looking forward to, said mostly in jest, but the January 27th is the start date for the IRS accepting individual returns. And just need to keep in mind that if any of the returns that you're filing have either earned income tax credit or they have additional child tax credits, those returns will generally be processed later, normally not until some point around Valentine's Day, if not later, and refunds not sent out until late February at the earliest. So just need to keep that in mind if you are handling any returns that fall under that criteria. It's easier to tell the clients in advance that the return may be held a little bit, the refund rather may be held a little bit, rather than have to answer calls and emails surrounding those returns. Just saw we just had polling question number 2.
Yeah,
I don't
thanks,
know why
Steve.
we have polling questions. Yep,
Polling
polling
question 3 just
I
went
think
live.
is just went live. All right. So next on my agenda is the wonderful Form 1099-K. And one thing that we need to keep in mind, this form has been one that I've been on the IRS for over the last 2 years at least at this point. And similar to beneficial ownership, this is certainly a gift that keeps on giving gift that keeps on changing. Finally, towards the end of 2024 calendar year, the IRS came out and said that they're not going to be enforcing any of the 1099-Ks and advised all the providers to not be issuing 1099-Ks unless the income level has reached or surpassed the level of $5,000. If nothing changes during 2025, that threshold drops down to $2,500 and finally drops to where the provision is of $600 in 2026. One point to keep of note in this is that there is no floor on the number of transactions that needs to be applied along with the income threshold. And also that there is no aggregation rules that come into play. It's not that similar to a 1099-B where you can just summarize all of your data and just say, okay, here's my proceeds, here's my cost basis, here's my gain or loss. If it's a gain, they have to be broken out individually on Schedule D. If their items are sold at a loss, they go onto two separate spots on Schedule 1, noting that there is no loss. It can only be, the basis can only be taken to the extent of the basis can only be taken to, it can only be taken against the revenue. You're not able to take a loss for the sale of personal items. So that is certainly one that we've been keeping an eye on, and hopefully at some point during 25, this will get resolved. There's been some various legislation looking to move this back up to a $20,000 threshold along with a significant number of transactions. But at this point, that certainly hasn't changed. Everything right now is still as slated on this slide. And if something changes on this, we will be updating accordingly. Next up is PTIN renewals. In October, the renewal for PTINs opened up at a rate including the processing fees and everything else to $30.75. And that's one that as you get ready to start filing returns for this filing season, the people that appropriately need to have PTINs, you should make sure that you have your renewals done. The IRS could at some point bounce returns filed under invalid or unrenewed PTINs. I know I've just taken a case on myself that as soon as I see the opportunity to renew, I do take advantage of that sooner rather than later. And also keeping in mind when you're renewing your PTIN, you're also verifying that you have a WISP or written information security plan in place. So if in the event that you were to have a breach, that's something that would be looked at as far as if were you following your procedures. The next is something that's actually new coming up for 2025 filing season. And it's one that I think we've all who prepare individual returns has seen multiple times, sometimes each year. Tax return gets rejected for the parents or for a spouse or an ex-spouse because either the child filed a tax return and claimed themselves, or that the ex-spouse claimed the wrong children, accidentally, of course. And this is one that the IRS is putting in a revision to the they're putting in a revision to the IP PIN program, which would allow the primary taxpayer, if they were to have an IP PIN, they are then able to go and have their return accepted by the IRS, and then the IRS will process through the same way they normally would to determine who is eligible to claim the dependent children. the big change in this, in the past, we would normally have to go through and amend a return, or we would go through and have to really amend the child return, then wait and then amend the parent return or file the parent return. That normally takes 15 to 20 plus weeks in order for that to get processed. So this is a way, the processing of these returns is still going to take time, but at least at this point, it's out of our hands as the practitioners, and it's something where the taxpayers will be getting information. We still might have some work we need to do to resolve, but at least it's something that the IRS is doing to alleviate a lot of backlog within amended tax returns. And the last update, just beneficial ownership. As I stated before, this is really the gift that keeps on giving. And unfortunately, I guessed pretty accurately, or I think I was off a day when I had said that the rules were going to change on Christmas Eve. Well, they changed the Christmas Eve, and then a day or so after Christmas, they changed again. As of the timing of, as we're talking now, beneficial ownership reports are still viewed as unconstitutional. The plaintiffs in the case, this had been filed to referred to the Supreme Court of the United States. In early January, the plaintiffs of the case in Texas submitted in their views on things and their correspondence, namely stating that until the appeals court hears the case, any filings that would be done by business owners could be detrimental and affect the businesses themselves. So at this point, the Supreme Court has not ruled, and right now we're waiting till, I believe it's March 25th or somewhere around there, when the case being appealed is supposed to start hearing the appeal. There have been 3 or 4 other cases around the country that are in appeals, and some of which date back to last March, which was the initial case down in Alabama with a small business organization. What made the Texas case different was that the injunction was nationwide as opposed to only those that were party to the lawsuit. So similar to these other items, these are items that we at the tax committee, we at NCCPAP are really following and staying on top of. NCCPAP has participated in a national coalition of accounting organizations addressing the issues, especially surrounding beneficial ownership. So we've really been involved with this for probably the last, probably close to 2 years at this point. And it's one that we're staying on top of, and we'll be keeping membership updated as to any changes that are taking place. And hopefully it'll just be viewed as remaining as unconstitutional. And the downside that companies may face is that if they have in fact filed their beneficial ownership report, they are not able to be rescinded. So at this point, if you filed it, it's filed. And if a company were to get sued, that report is something that is able through a court order to be turned over to the plaintiffs in whatever case it may be. So that's the updates that we have from a tax perspective. So if we have any questions, Michael, that may have come through Q&A, we'll certainly entertain those now.
Steve, I don't have any questions through the Q&A. I'm just looking at the chat, but maybe you want to talk a little bit, as Neil had brought forward during his talk, about Friday's town hall meeting.
Certainly. Thank you, Michael. On Friday, what we've done in the past with our town hall meetings, it's really an open forum for our members to any items that they're seeing, whether they're individual, whether they're business issues, that can be brought to the attention of either the IRS and or Congress. Just an example of one that we had last year related to the withholding rates surrounding bonuses and such, that the company has an option to just withhold at a set rate, regardless of what the tax liability may be. I believe that set rate somewhere around 20%, up to $1 million, bonus, and they're withholding at 20%. That person's going to be in a 37% tax bracket, and really would have some significant liability. So that's an item that was addressed last year. I think we're going to continue with, and you can always look up through the NCCPAP library what our prior agendas have been. And it's one where don't feel that if you have an item that you're going to have to go through and do a big dissertation on. If you provide us with some basics, we'll work with you to come up with what the agenda item may be. And then if something that you give us the basic facts, we'll put together, but we'll send it back to the person to make sure that what we put together really fits with what their thought process was. So just need to, if you're able to make the time on Friday, it's certainly beneficial. Even if it's something where you don't have any items per se, but you may hear of an issue that somebody else has that will just make you a little more informed during this coming filing season as a way to help your clients. So hopefully we'll see all of you on Friday at the town hall.
Thanks, Steve. I just want to press the point just one more second, just between the actual broad strokes, I guess, that you're looking for these issues related to individual issues that people have with the IRS and trying to contact them. These are broad policy initiatives that NCCPAP is trying to set forth as the part of their agenda.
Correct. And what we look at is not just a one-off of, oh, the IRS wasn't nice to me, or they didn't relieve this penalty, or they didn't abate a penalty or remove interest. We're looking at items that are more systemic in nature, or something that's really could stand to be reviewed or updated within the tax code that may have to go through Congress as opposed to the the IRS making a change. So, I mean, that's certainly something that, any information we get during those meetings, we can certainly work with the person or say, hey, let's talk about this a little bit more offline to make sure we fully understand what someone's issue is and whether or not it is truly a systemic issue or an issue we need to put onto our agenda. And there was one item I see in the Q&A.
Yeah.
An HOA filed a BOI report and just had an election in January of 25. Should they wait to file a revised BOI report until after the SCOTUS decision? And I would say at this point, the filing is deemed as unconstitutional. So until that changes, and that may change through SCOTUS, or it may change through the appellate court down in Texas. But until that point in time, what the advice that we've been hearing, including from FinCEN themselves, where they list on their website, is have the data ready so that if at a point it does become legal and a requirement, that you have the information readily available to file that, in this case, a revision, or even our clients that we haven't filed or we advise not to file, whether it was us filing or them filing, that they just have the data ready to roll, but to hold off until they reach that point. And if they're filing on their own, it's free through FinCEN. Outside organizations will charge fees that may not need to be charged if they're preparing it themselves. Obviously, if they go through us as CPAs or other paid sites, there will be fees that would need to be charged. And hopefully that answers your question. for the gentleman who posed the question in the Q&A. All right, another one already. All my BOI reports are already approved by FinCEN. Should I be concerned with any upcoming issues? At this point, no. Other than if there are changes to the filed report, just make sure that they're ready to submit changes within what will then be, at least based on what we hear now, a 30-day window with which to file any updates into the BOI reports. But again, once it's filed, there's no way to rescind what has been filed. So hopefully that answered the question for the submitter. And unless there's, you're quite welcome. And unless there's any other questions at this point, I'm going to turn the floor back to you, Michael. And this way we can get ready for the meat of the presentation today, which is Gary Brown. So back to you, Michael. And thank you everyone for attending today and your interest with NCCPAP.
Okay, well, I will jump in for a second. We have Gary Brown, our NCCPAP Executive Vice President, now speaking about trusts and estates. Again, if you have any questions, please put them in our Q&A and we will get to them at the end of his section. And also be aware we are still putting poll questions up as well. Thanks.
Good afternoon, everyone. My name is Gary Brown, as just mentioned. We're having beautiful sunshine here in Central Texas, but Mother Nature was kind of confused yesterday and last night, and we have parts of Texas that had their first blizzard warning in history in East Texas that is on right now. I've got a layering of white stuff, so Mother Nature had a lot of dandruff out here, which some of you are probably well used to, but Texas isn't. Texas is shut down for the next couple of days. So interesting area of the country. Hopefully, it's kind of interesting where things go. What we're going to talk about today on estates and trusts is going to discuss the estates, talk a little bit about a will versus a trust, some basics, some 1040 or 1041, Form 1041, as well as there's a couple comments on 1040, the 706, and estate planning. From an overall standpoint, this is a unique tax area that normally applies to several things. One, a deceased person's estate, income with respect to decedent, income that's received after they die, a formal trust agreement, or a bankruptcy estate. And normally you'll use the 1041 for reporting. However, if you want to select portability of the spousal exclusion, you'll file a 706, as well as if they exceed the threshold. So you'll hear a little bit more about that as we go forward. When we were planning this within our education committee, we found that it's kind of interesting that a lot of people don't do that, and don't file 1041s or 706s. It's one that we found in overall practice. I'm a member of several tax organizations that see the same thing. That many of the members do not file these returns. So it's a unique area that requires some knowledge. It's fairly easy to go with, but you got to know what you're doing. We having a poll question here, Alex?
Yep, I will launch it right now. You could continue.
Thank you. Okay, so what is the estate? The estate is basically anything and everything that the decedent owned at date of death, anything that they received after death, let's say before things transferred to the beneficiary, you get dividends or you have a retirement distribution, etc. That's what's known as income with respect to decedent, or IRD. The will control who receives the money, and you have step up under the current law. And what that step up means is kind of interesting. If you're in a community property state, let's say you have a house that's you bought for $50,000, it's currently valued at $1 million, which is very possible in Texas and some other spots around the nation. If you're community property, it steps up to the $1 million. If you're not in a community property state, it'll step up only to 500,000, which is the half related to the decedent or the person that died. The other half will be the 30,000, that example, from a $60,000 basis. So they'll have 500,000 plus 60. So the new basis on that would be 560,000 versus $1 million if you're in the state of Texas or another community property state. If you have income exceeding $600, you have to file a Form 1041. If you're a non-resident alien as a beneficiary, you have to file. And if it's a qualified disability trust, there's a $5,000 exemption, so you don't have to file until you reach that. If a will exists, then all the assets are divided in accordance to the terms of that will. If it refers to or sets up a trust, then the trust document will dictate who receives. If you don't have a will or trust, it's called intestate, and state law will define who it is. So you do have a will, whether you know it or not, even though you've never made a formal document, your state will define what happens. And each state is a little bit different, but generally, under state law, if you're single, it goes to your parents first, then to your siblings. If you're married and have biological children, the spouse will get all the community property, plus 1/3 of separate personal property and the right to use the real estate for life if a community property state. That may not be the same in non-community property states. The children will get the balance per stirpes. We'll talk about what per stirpes is in a minute. If you're married with non-biological children, the spouse will get 1/3 of the separate property and the right to use for life. The deceased spouse's children get everything else, including 1/2 interest in community property if you're in a community property state. Now, per stirpes refers to the beneficiary and what happens if someone dies before you. It's divided equally among children, nothing to grandchildren if parents are living. If one child dies before the parent, you split their share to the grandchildren. So if you got 3 grandchildren, each will receive 1/3 of the parent's share if the parent is deceased. If the will states per capita versus per stirpes, everyone gets an equal share. So if you have 2 children and 5 grandchildren, 1/7 goes to anybody or to each of them. If there's 2 children and one died, then plus you got the 5 grandchildren, it's 1/6 to everyone. So that'll change for everyone as you go, depending on the status of the dependents. It looks like we have another poll question coming up on a will versus a trust. Some people will say if you have a trust, you don't have to worry about probate. Well, in reality, everything goes through probate, and so it's one of those that it's all there. Problem is, if you have a will, you have information that is public knowledge, and the vultures can come in and start saying, "I'm here to help you." If it's the wife, they'll come in and say, I can help you manage your assets. I can help you distribute stuff." And typically that's what we call a vulture in those states that see a lot of that. And unfortunately, without proper advice, you may not want that person handling things. So the advantage with the trust is the details are confidential. It's not disclosed. You go into court, and typically in our area in Texas, we have one court that handles it all. You walk in there, you say, "We have a trust." The judge says, "Okay, fine, thanks." Done. Now, one thing that they do is they may assign if there's something wrong with a trustee or executor, say that one person is deceased, the court will assign someone to handle the case. But everything is confidential. All that the world knows is there's a trust. They don't know you may have $1 million piece of property out there or several $1 million in cash that they can help you with. Right. They're there to help you. Do you need a trust? Well, it depends on the individual. Trust is life is easier if you have a trust for the survivor, or if the survivor is incapacitated, but it should always be combined with a will that refers to the trust. There's a lot of attorneys that will say you don't need a trust. Others will say you should have it. It depends on the individual and depends on your assets, what your goals are, and what you want to do with your assets after you die, who should receive them. The trust, why should you have it? Well, number one, it defines the beneficiaries. It can give rules on managing the estate and any gift tax liability. It will say, I want 1/3 of my estate to go to ABC charity, and that'll happen. That money will be distributed before everything else goes out. It also will ensure if you have a special needs beneficiary, say somebody that's disabled or a child that needs extra care, or even a parent or relative, they'll be cared for even though you, the person that set up the trust, may not be still alive. It also can receive life insurance proceeds and use those for the benefit of the beneficiaries. And as we said a minute ago, it's confidential. So unless you have the data, you aren't going to know what's in there. Now, one of the interesting things on confidentiality of trusts, we've seen a couple cases in the past that individuals did some real estate fraud. They put all their assets into a trust, and unfortunately, they were sheltered from the lawsuits about the fraud that they invited. So it can be positive or negative depending on what happens going down the road. A living trust, there's two types of trusts out there. A living, which is revocable, which means you can change it. An irrevocable trust is one that cannot be changed. The terms cannot be changed in there, and you have to go to court to change it. And sometimes it works, sometimes it doesn't for change. It's revocable and can be changed anytime on a living trust, anytime up until you die. It's your alter ego, so you don't file a tax return for it. It uses your social until one of the individuals that's in that trust dies. You have a trustee to manage it. It can be yourself, can be your kids, can be a institution or someone else. I've actually seen CPAs that are named as trustees or attorneys. Now, one of the things to think about on your trust when you're setting up, make sure the person is responsible. We've seen several cases that the trustee was a ex-husband, was a husband of one of the beneficiaries, and then all of a sudden there was a divorce. They had no interest in handling stuff, and it wasn't handled properly. Or as trustee, they could distribute things from there as long as it went to beneficiary, but they could put other claims against the estate. So be sure that you have somebody that is trustworthy, knowledgeable, and knows what they're doing, that's a trustee or the executor of a trust and estate. It protects you for incapacitation as you've already defined what your wishes are, who's going to get your money, how the money's going to be spent, whether Fluffy, your cat, is going to be taken care of, or whether a friend or relative or a beneficiary such as a charity that you've been working with gets some money. So it's always out there to help define who receives the money. Living trust doesn't protect the assets from creditors, but if it's irrevocable, and I see there's a typo in there, if it's irrevocable, the assets are protected. You can set it up yourself, but as with anything, you should use an attorney, because remember the old clause, only a fool will use themselves as an attorney in a court case. So you never know what's out there. There's internet cases that you can get it for a few $100s, get a trust set up, but it may or may not have the terms that are required for your state. Each state is different from the state tax laws, and Texas, an example, is one of the easiest in the nation to transfer assets. But if you don't have the right terms and clauses in there, that trust may or may not be valid.
Gary, just real quick, we just gotta, I don't know if you want to stop now or you want to do questions at the end. But one of the questions that come into Q&A was, why does a trust have to go to probate? Is that just a Texas thing that you're speaking of?
It's Texas. I've talked to several attorneys, and they've said that a lot of states want it to go in front of a judge. It's best to do that just to make sure it's passed. There's minimal cost to do it. Theoretically, you don't have to, that you can avoid it. But Texas definitely suggests doing it. But I've seen both ways.
Right. So the best thing is to check the state that you're practicing in.
Yes, sir. That's the best practice.
Thanks, Gary.
You're welcome. There's various types of estates and trusts out there. One is the decedent's estate that we talked about. That's anything that decedent had. There's a simple trust, a trust that for distribution of corpus, which is the assets and principals. And I see a question out there: is a grad a good idea? We'll talk about that for planning. It's a great idea going forward. Yeah, it may not be valid or good for everybody everyone's situations. There's complex trusts. There's qualified disability trusts, grantor trusts, bankruptcy estate, pooled income funds, qualified funeral trusts, and then rare, sometimes you'll see a ESBT, which is electing small business trust with or without S corp income, or qualified subchapter S trust. Those two items, I've never seen one in my career, and I've been practicing for a number of years, but we have there are some cases out there in case law about those types of trusts. Typically, if you have an S corp, you do not want a trust to be the owner, but if the owner of it dies, or it was one of the owners dies, you can use that ESBT for the S corp until you transfer out. It typically has to be done within a year or two. Okay, what's the difference between a simple and a complex trust? Simple trusts are very straightforward. All income has to be distributed on an annual basis. There's no principal distributions and no distributions to charity. Well, the complex one, you can distribute some or all the income. You can distribute principal as you want, and you can distribute to charity. Plus, you can distribute ordinary income first, then the dividends followed by and interest followed by capital gains. Now, within a complex one of the advantages there is you can do some estate planning. And by estate planning, it's really tax planning of how to handle the taxation of items within the trust. So if you plan properly, you can minimize tax for both the estate, and we'll talk about the rates in a minute, but you can minimize the tax for the estate as well as the beneficiary. So there's some opportunities that can come down the pike with a complex trust that aren't there for a simple trust. A lot of times on simple trust, everything goes out equally. A complex trust, you can decide, okay, who should get it, and depending on the terms of the trust, some beneficiaries get 100%. Some will say, I don't want anything. It just depends on what's there. Always watch your terms of the trust. If you have a grantor trust, all the income is taxed to the grantor, regardless of distributions. It's really the alter ego of that grantor, and the other trusts are separate entities. A revocable grantor trust, all income is reported on the grantor return until the grantor is deceased. An irrevocable grantor trust, income is earned by the grantor even though it's distributed to someone else. Now, one of the things that can be done from an estate planning side is we have seen several that we've set up with our clients and through attorneys, that we have set up a decedent's trust, special type of trust. It's a grantor trust, but we've transferred everything in there. In one case, we actually had the attorneys who were working on the case originally. The individual would have had, upon death, the family would have had a estate tax bill of about $50 million. They had a lot of oil and gas, a lot of land, a lot of other things in there. We looked at it from a standpoint of how can we change that? And before the individual that was covered by the trust died, we set up multiple entities, transferred assets into those entities, so they became now the assets of LLCs and partnerships, set up some various notes for the beneficiaries on there, and that kind of reduced the estate, because now all of a sudden it was owned by the kids, and the kids all had self-canceling notes there that upon the death of the original grantor, they got the assets. So it's kind of an interesting type case, and we'll talk about distributions on capital gains and whether the trust pays the tax in a second. There's a couple rules on that. I see that was a question out there. Historically, there were AB trusts. That's kind of changed over the last few years, but an AB trust, was one whereby the trust gave the survivor half of the total estate, the decedent got the other half. And it typically was split based on exclusion. Now that we've got the $13 million out there for exclusion, you don't see as many of those. Older trusts have them. The trust, all the assets were split in two between the two trusts. And that way, the survivor's trust was available for the survivor. The decedent half would never be taxed again. So it's kind of an interesting way to do those estate planning. You still see some of those that may come back into popularity again when TCJA expires at the end of 25. You may have a split interest trust. That one will file on a Form 5227. That includes charitable lead trusts or charitable remainder unit trusts and pooled interest trusts. There's various code sections for those. Watch your software because some will be able to handle this, some won't. UltraTax, which I use, has some good programs for that. Lacert, I believe, does. Drake and some of the other programs do not have the capability or didn't the last I looked. So watch your software. If you have one of those, you come in for a client, you might have to pass that case on to someone else that can handle it for you because your software won't handle it. Due diligence when you prepare for a trust or you have a trust or an estate, make sure you always get a copy of the death certificate that has the information of the individual's correct name. It has their social. It'll have their date of death. And anybody that's out there, you need to get a ID to make sure that you have the right person, because one of the frauds we've seen in the past was someone came in for to set up a trust. They claimed that they were a beneficiary. They had a death certificate that was bogus. And so if you don't have the ID, you could be participating in that fraud. So make sure you always have an ID anytime. It's good practice for 1040s as well. We make sure we have IDs on every one of our clients, including the kids. And on the kids, we ask for a birth certificate as well as a copy of their social security card. That way we know and can verify that they are who they say they are. Always get a copy of the will and trust documents. Get a probate document if necessary so you can determine the trustee or executor of the case. The EIN letter that they have, and EIN letter is important when you start doing the return, because page 2 of that EIN letter will have the family name listed on the top in small letters. So if you want to know who the family is, you can take it right off of that EIN letter. And if you don't have the EIN, typically when the trust is set up for a living trust, there is no EIN, so you may have to get one for your client. Always review your current and prior returns to verify that everything is included both on the 1040 for the decedent as well as that you've accounted for all their assets on the estate return. And so that's good due diligence. If you just take what the client gives you, as there was a case a while back on attorneys lie, everybody lies. Well, people forget. People don't bring things. Well, I didn't think that was necessary. We didn't get any distributions out of it. We didn't get any dividends from it. It was all reinvested. Wrong. Same issues that you have with your 1040s. Be sure you recognize it here. And if they're an existing client, one of the things we do is we get a POA for all of our clients. It's kind of an interesting factor. I've seen arguments both ways of why you should have it, why you shouldn't. We get them for 2 reasons. One, people forget. Most of our returns, especially the complex ones, are on extension. So we can wait until June, get a wage and income statement, so we know that we've got everything that was turned into the IRS. And a lot of your senior clients may forget. They had one Fidelity account, they thought. They may have had 5. The POA will show that so you can see what's there. Now, if the person's died when they come in there to you, you may not be able to get to the POA because the IRS will shut them down for deceased individuals. But there is a way to get it if you want to or need to. Be sure to identify who the person is that you're working with, as we said a minute ago. and allocate income between the estate and the 1040. So one of the things you look at there is 1099 nines from brokerage statements. Person died March 31st. Your statement may be for the full year that you've got. So you need to allocate the income between the 1041 and the 1040. What you do on the 1040 is you report all of it on Schedule D or on the dividend Schedule B for dividends and interest. Put a credit in there showing the allocation to EIN number, whatever it is. And on the 1041, you do the same thing, allocation from Social Security number, XXX, whatever it is. Do the same thing for expenses. And if you have rental real estate that's involved, you can break it down for a partial year. Anytime you have a 1099 to match for rents, always make sure that you've identified what's there so that you can avoid problems with the IRS. If you have a $50,000 1099 for rent and you're only showing 20, you're probably going to get a question. But if you have it shown on Schedule E that it was allocated to EIN XXX, which is the trust or the estate return, that'll solve from an audit standpoint. Won't stop audits, but it will solve it. If there's a refund, make sure you file the 1310 and do that with the return if possible. You'll need the name, Social Security, and address of the recipient, and always answer the questions correctly. Because if you don't, I know UltraTax will bounce it if they're not answered correctly. One of the questions that's in there is, has someone been named by the court? And if you put yes on there, it may bounce it. Yeah, it's best to say no. Yeah, it's kind of an interesting, it's a backwards way to handle the 1310, but we've seen that on the UltraTax returns. You also may not be able to e-file, depending on when the person dies, as the IRS is freezing the account. Now, in the last couple of years, there's been a way to get around that. If the husband was one that's deceased, always put after their name, Joe Williams, parentheses, deceased, parentheses, and then spouse Mary. That way it will go through. Otherwise, the IRS is going to think it's an identity theft return and will bounce that return. So make sure you always put the word deceased after the person that died, after their name, and then the return will go through. Yeah, periodically we see them bounce, but most times it will go through. If you don't put it there, the IRS will reject that return. When you prepare the 1041, you always need to know what type of entity, whether it's a simple, complex, etc. Unless it's a complicated state, the final return needs to be done within 2 years. You need to identify the date created or date of death, and if terminated, the date of termination. Also, you need the decedent's Social Security numbers, unless it's a trust, because we've seen several that the beneficiary may not come around until they're age 21. They may not be available until a later time period, or it's a complex trust that they decided not to give anything out. It's going to say to build that principal and interest within the estate. So you don't need the decedent's social. Good practice to get it and have it on hand. You also need the name of the fiduciary, their social and address, because that's the address the estate's going to have when you file it. And the family name is usually the last name. If you have Joe Mary Williams estate, it's going to be Williams as a family name. However, that we've seen issues on. That's why you should always get that EIN letter, because the second page, right in small letters at the top, will have numbers as well as the family name. So that's an easy trick to find it. And always get the date of birth and ID on the beneficiaries and their Social Security numbers. It's good to have phone numbers and emails as well. We always provide to the clients, but you don't have to. We send them to the beneficiaries, the K1s. Some firms just give them to the trustee and let the trustee send them out. You have to refer to the trust document if you have one, because the investment policy is there. From a tax standpoint, trusts are taxed very similar to a 1040. There's preferable capital gain rates. They're subject to alternative min tax. You can deduct certain expenses. The nice thing on a trust is some of the stuff that is in miscellaneous itemized that no longer exists after TCJA, or the current tax law, are allowable on estates. And the main difference between a trust and an individual is a tax rate. It's significantly compressed, and you'll see that why in a minute. Distributions are taxed to the beneficiary. If you don't give a distribution, 100% of the income is taxed at the estate level on the 1041 or trust level, whatever it is. If you distribute it down, you're going to reduce net taxable income by that distribution. So it's a distributable income deduction that's out there. Grantor trust can be irrevocable for gift and estate tax, but still cause the grantor to recognize taxable income. One of the nice things within trusts is at year end, and this is a planning tool that you can use, if they haven't given out enough money to match the income so that the estate doesn't pay all the, or the 1041 doesn't have all the tax on it, you got 65 days to make a distribution. So one of the things we always do at year end as part of our planning is we look at what the income of the trust is and then lay out who's best from a tax standpoint. Now, remember, that's dependent upon your trust agreement. It's dependent on whether it's a regular estate or if it's a trust, and it depends on some of the clauses within that trust. Some of it you can't distribute because of the terminology within the trust agreement. But it's always best to plan. You can help your client out there so they don't have a big surprise year end and say, oh, how come we're paying taxes on 95% of the income? You didn't tell us to distribute. Well, number one, that's the trustee's responsibility. But as a good CPA, you should be planning and scheduling them out so that it's beneficial for your client. Capital losses will only pass when the trust terminates. Same rule as individual on the $3,000 maximum that's in there. Any RMDs for retirement plans received by the trust, you got the same 10-year rule there. And unless otherwise defined, it's based on the RMD factor. You have a 10-year lump sum distribution on the 10th year. Any assets in trust upon death, there is no step up unless it's a grantor trust. Okay. Income within the trust is very similar to that for a 1040. Deductions work similar to the 1040. Depending on the type of trust or estate, you have different exemptions. The decedent estate is 600, simple is 300, complex and a pooled income is 100, qualified disability is 5,000. Your accounting income includes everything that's income to that estate or trust, including non-taxable income deductions. So if you have non-dividend distributions, you need to add that to your accounting income. Then once you have identified all your income, you're allocating all the expenses across the income elements. So what's on the K1 will never match the 1041 income. Yeah, so one of the things that people, when they first start doing 1041s, will say, how come this doesn't tie to what the income is on the return? Well, that's because you've allocated expenses. And that's one area that you need to explain to your clients that what they have on the K1 will never match because of the allocation of income, of deductions, I mean. Capital gains are considered corpus. I saw a question earlier. Do we distribute them? The only way you can distribute capital gains out from a trust is if the agreement dictates that you can. Otherwise, it's part of the corpus and has to stay within the trust for taxability. Counting income is the income that's available to pay your trust beneficiaries, and your distributable net income is the amount that's taxed to the beneficiary. Any distributions in excess of that DNI are tax exempt or treated as a distribution of principal, and they're not taxed to the beneficiaries. Now, capital gains again can only pass through if the document includes them or requires them to be distributed. So your income there for DNI is your total income after expenses minus capital gain income, and that's what's taxable there for distributions. So remember, your capital gains only pass through if it's allowed. Otherwise, you're paying tax within the estate on it. Now, what's the downside of a trust estate? Remember a few years ago, the children's income was taxed at estate levels? Well, government loves that because 37% is the tax rate for anything greater than 15,200 this year, 15,650 with inflation next year. Capital gains have zero expense up to 3,150, 15% for up to 15,450, and 20% greater than 15,450. If you owe more than $1,000, there's estimated tax penalties, or if you've underpaid more than 10% of the tax, there's penalties there. Now, just like an individual, you can remove or reduce penalties if there's a reasonable cause. So always watch what's out there and do your client a favor. If it's something that's every year, we probably can't do it, but you can always request it for removal. Trusts are very, Form 1041, Trusts and Estates. QBI applies the same as for individuals. Foreign tax can be applied at the trust or beneficiary level. NIC tax, net investment tax, applies on top of the 20% capital gain rate. And watch depletion if you have oil and gas or mineral properties, because that can be applied at either the trust or beneficiary level. Due date for 1041s is April 15th, and with extension, it's September 30th. Just like individuals, if you miss that second date, there's failure to file penalties. Now, 706, that's the big daddy of the states. Your exclusion is 13.61 million this year. Next year, 13.95. And by next year, the current year we're in, 2025. Yeah, we call this year is the one. I'm saying that because that's what we're filing right now. And it's filed if your gross estate plus taxable gifts and exemptions are greater than exclusion. Got to review your gift tax returns and transfers the last 3 years because those are added back. So you have to be careful on whether you have to file or not. Now, portability is an important thing. It's very good for your planning going forward, especially with the expiration of the current tax law at the end of this calendar year. Because remember, we go back to the old rules, which are $7 million. And so if you want to have a larger exclusion for the beneficiaries, do a portability election for the spouse. What that does is it will transfer any unused exclusion for the deceased spouse to the survivor. So you'll use Rev Proc 2022-32, which allows late filing up to 2 years from death using a simplified method. On page 1 of the Form 706, you identify up at the top, filed pursuant to Rev Proc 2022-32 to elect portability, and you reference the section there, 2010 C5-4A. That gives you an additional exclusion when the spouse dies. So with a small estate, we had one this year that we saw a lot in 23 that wanted to do portability because they were worried about the election and what would happen, because some of the proposals from the former administration was a significant decrease, and it was unknown how far, but they were worried that they were going to lose all their exclusions. So we saw a lot of people that wanted the portability last year, and they may still want it this year, and should look at it if you have a large estate, so that you can transfer the extra exclusion to the surviving spouse. So let's say they have $8 million of exclusion that's available, even though their exclusion was 13, $8 million estate, that 8 million is going to be added on to whatever the exclusion is for the surviving spouse when they die. And if there's a non-resident that had U.S. Situated assets, you need to file the 706, and it's due 9 months after date of death with a 6 months exclusion. Okay, for a 706, what do you have for income? Everything. Anything the person owned during their life, real estate, stocks and bonds, any mortgages owed to them, notes, cash, ADs should be and, life insurance, any joint interests, miscellaneous property such as their personal property, which is furniture, clothing, jewelry, etc. Hobby items, which could be anything from coins on down, any transfers that are out there that came back after 3 years, or any annuities. All those are assets of the estate. Expenses are funeral expenses. You don't count on a 1041 funeral expenses, but you can take medical on your 1041. Administrative expenses, executor fees, your attorney, accountant, appraiser, any interest expense, property tax expense, real estate expenses, any court fees, or any expenses to maintain the assets. And what does that mean? If you have a house and you have to spend money to improve or maintain that until it's sold, those are all viable expenses of the estate. Return. Any debts, any bequests to the surviving spouse, any bequests to anyone, whether it be to a church or wherever, your foreign taxes, any credits for taxes for prior transfers are in there, and any generation skipping tax is also included as a deduction on the 706. 706 will have first page, and then all of these items, most of these items are listed in separate schedules attached to the 706. So you only have a summary on top of the return. If you file it and it's a large enough estate, request a letter 627. The fee on that is $67, and that'll show acceptance of the Form 706, the amount of the net estate tax, any state death tax credits and deductions, any generation skipping transfer tax the states are liable for. It'll take between 6 and 9 months to process it, and you may get an audit notice that the decedent owed taxes, or you didn't file some other documentation, or there's a belief concealment of fraud. Now, one of the things we've seen on one of the states last year, and there's actually 2 of them that we had, is they had not identified all their assets yet. They were trying to find them all. So we filed for the extension and didn't list an amount due. We knew it wasn't going to be due. We filed it for the portability only. The IRS came back and said they disregarded the extension because we didn't pay any tax. And we sent a letter back to them and said we didn't pay any tax because they don't owe. It's only being filed for portability. They had to identify their assets. The IRS said, okay, no problem, you've got it. So that waived that extension. Now, going for 2026, the final areas that we're going to talk about here real quick. Your exemption is going to drop to $7 million. Tax rates going up to 40%. If the estate's greater than $8 million, portability will continue. But remember, there's less out there. So you got 7 million versus 13. So there's a major difference in portability. Now, what do you do for the next 11 months? Yeah, they're out there. We're in into January right now. You still have time to set up grants where the grantor draws an annuity from the trust, any family limited partnerships that takes assets out of the estate. Irrevocable trusts also remove assets from an estate. Intentionally defective grantor trusts, where the grantor pays the tax even though the trust owns the assets. Any ILETs for life insurance trusts that remove the insurance from the estate. Any spouse lifetime access trust, SLATs, which IRS doesn't like these things, but they're a great tool to transfer assets between spouses, and any gifts. They'll also reduce the estate. Remember, anything within 3 years of death could be brought back into the estate. You need to review your estate plans with your clients before year end, because anything can happen. As we heard from earlier, they're going to be reviewing the end of the current tax law. It could be any time that a new law comes in, so it could change during 2025. Keep on your toes, watch what's going on, and see what's there.
Gary, thank you so much. Really appreciate you going through this. I know we're up against the hard stop here, but there were a couple of questions in the Q&A that I thought if you have a quick second, otherwise if you want to do this and you can have people reach out to you.
They can do both. Be happy to answer any questions.
So real quick, just some Q&A. Capital gains in the trust can't be passed to beneficiary if investments sold in order to distribute to the beneficiary. Is I guess that's they're asking the question relating to the tax sale.
Yeah, for a tax sale, it is passed if it's the end of the trust. Say if it's an estate, the final year those capital gains go down or capital losses go down. Otherwise, if the trust document does not allow for distribution of capital gains, then the trust, the 1041 has to pay the tax on it. Yeah, if it allows for distributions, you can pass them down, to reduce taxes. But unfortunately, if the agreement doesn't allow for it, that's considered a part of the corpus, which is the assets of the trust, and so it has to stay with the trust.
So that's going to be specific to the trust.
Yes, sir.
Yep. Okay. And then does rental income or loss pass through to beneficiaries?
Yes, it does. Same as any other type of income. It's accounted for just exactly the same. Same as if you have a business that the trust owns, and we've seen that a number of times. Yeah, you got your normal deductions that are out there against the income, and then the net income will pass through to the beneficiary.
Right.
Now, one of the
The
things
income or
there-
loss.
Yes, income and loss. Now, that number again may be modified by other administrative expenses of the trust that could be reducing that stuff as well. And you'd have the same rules for passive and active real estate.
Okay. And if a grantor trust owns a house that is sold, the capital gain taxable to the grantor, even though the sale proceeds cannot be distributed to the grantor?
Exactly.
Okay. And just a final one here, and I guess this is sort of a landmine one. Can a trust deduct investment advisory fees?
They can. You have to ask how much of it is for management of the assets versus advice.
So it
Yeah.
has to be bifurcated by the
Yes.
broker.
Yes, sir.
Okay. I appreciate it, Gary. Really tremendous job. And thank you for all your time and effort in putting this together and hosting this presentation. Have a great day, everyone. I think we're up against our time limit, so I'll let everyone end the conference now. Thanks.
Thank y'all.
Okay, so I think there was Alex, is that out? Let's see if she comes back.
Yep, that's it.
Oh, perfect. I think there was one last sneak in of a question, but I'll ask them if they want to ask Gary directly.
Yeah, we could leave, if anyone who has other questions on their way out, we'll be posting the slides to the NCCPAP Now resource page. We'll also be sending out the links to that, as well as the recording will be ready probably within the next few days, but the slides should be available in the event library probably within the next 15-20 minutes.
Oh, it's great.
Awesome.
Thanks, everybody. I'm going to end this for you all. Thank you all for
so much.
attending.
Alex,
Yeah.
Michael, Gary, thank you very much.
Thank you. Appreciate it.
Thanks, everyone.
Thanks.
Thank you.
Bye.